Hi, I'm Jim Jackson, and I am bonding over bonds with Kevin Kazi. Kevin, welcome back to Bonding Over Bonds.
Thank you, Jim.
Now, Kevin, as we move into this part of the year, investors often start to consider how they want to position themselves into year end. What are some of the things that they should be thinking about?
Well, the Fed has sent a very clear message that they're going to continue to tighten monetary policy until inflation comes down,
Mhm.
even if unemployment rises or the economy softens. So I think we're looking at a more volatile rate environment going forward to at least through year end,
Mhm.
with increasing risk to economic growth.
Kevin, I think we've seen some of that in markets this year. So this
Mhm.
has been some of the worst fixed income returns that we have seen. It's given investors pause as far as devoting more assets to the asset class. We think, however, that is premature. We think that the case for holding fixed income in your portfolios to help management risk, that case remains intact.
I agree with you, Jim. I mean, even in a year where fixed income returns has been the worst we've seen in the
Mhm.
past 40 years, the maximum decline of the Bloomberg US Ag this year uh, was still 10 percentage points less than the S&P
Mhm.
500. And also the yields we're seeing in investment grade fixed income are some of the highest we've seen since the global financial crisis. And as you know, higher yields often equates to higher income for fixed income investors.
Sure it does. One other thing that we've seen is the yield curve has flattened in
Mhm.
2022. This has resulted in the Bloomberg 1 to 3 year credit index yielding more than the Bloomberg US aggregate. What this means for investors is that they can generate yield on the shorter end of the curve so they don't have to take as much interest rate risk to generate the same amount of yield. So, Kevin, thank you. And thank you for bonding with us over bonds.